want my founders to focus on just three things, right? On talent, on hiring, on building product and selling. That's it, right? Nothing else. We are very realistic that we are not running the companies and we're not prescriptive in the sense we listen, we're sounding boards. But I think what's different is we're also not telling the founders that this is how you should run it and change your business model because you're backing them, right? If you were running a company, then you'd be doing a startup and not running a VC fund. It's really important for founders to equally diligence the VC because I feel it's even more important. Remember, we are spreading our bets. We're doing many deals. The founder is putting their life, his or her life, in the hands of the VC. A lot of people feel it's one-way street. I feel the other way street is equally, sometimes even more important. Is that VC right for you? Are they even looking at your sector? For me, it's very important. Does somebody talk differently to me, but they're ordering coffee? Will they talk very differently to the waiter? How do they? Very often, it's very interesting. You do one meeting on a Zoom, the other meeting to a restaurant. Just see and just as an example, just allow them to order. Right? Just see how they will interact with everybody around you. That gives you a cue of how they will deal with people. When you have a co-founder, is the only person along with you who knows what that journey is. So when you're a single co-founder, I would say some people say, "Oh, I'll keep the equity for myself." That's one way of looking at it, right? I've got 80% equity. You share karo, right? I'll share with the others. The other is that it's very lonely. Who's there with you to share it with? Who's there with you in this journey? You're putting tons of weight on your own shoulders. Who do you have to share it with? Youth is super interesting because it's the consumer segment. Secondly, youth is also the ones who are going to create startups of the future. When I see that Dunzo drive on Yulu, not only is it very dear to Bloom, but it's dear to India, right? And then you see the person riding the bike is young, the founders of these companies are young, and you're basically backing India's youth. I think the IPO orientation is more important for founders to get that this is a long-term journey you start, but essentially you should be in this to build a sustainable, long-lasting company and not think of the IPO as just a flip to return money, but really to a new journey starts there.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Sanjay Nath with us. Sanjay is a co founder and managing partner at Blume Ventures. Blume typically invests in pre seed to pre series A startups and has built a large portfolio over the past decade, holding positions in edtech firm Unacademy, quick commerce platform Dunzo, micro mobility startup Yulu, among many others. Recently, Blume announced the close of a $250 million India focused fund. In this episode, we'll talk about Blume's origin story, focus of the new $250 million fund, secret behind Blume's success, contrasting US and India startup ecosystems, why this is India's decade, common traits in founders that win over and over again, is a co founder really necessary, perspective on exits, learnings, mistakes made along the journey, and a lot more. Just one last thing before we start. If you haven't subscribed to VC10X yet, please do and give us a 5-star rating if you find value in this episode. Now, let's start. Hey Sanjay, so good to have you on the VC10X podcast. How are you doing?
Good evening, Prashant. Thanks for having me. It's great to be here.
Yeah, pleasure hosting you, especially at this time when you've just announced the close of your fund number 4. So many congratulations on that one. And to start the conversation, like we all know welcome. So we all know where Blume stands today, right? Everyone knows it's a big name in the startup industry, especially in India, right? But let's start this conversation, talk about where did all this get started? What's the origin story of Blume? And also a little background about yourself, how you got into starting Blume Ventures.
Absolutely. It's always interesting to talk about the genesis and the story, and the story we started. So, I'll call myself a accidental VC in the sense that, just coming to background, I'm a Bombay boy. The first time I went out was to Bits Pilani. You mentioned you're in Delhi, so quite close to Delhi. It was always told as it's equidistant from Delhi and Jaipur. So you have to take the train or bus to either one of those places and then make it from there. And then, I was in the US for quite a while. I was not exposed to venture or startups at all. I was a management consultant with PricewaterhouseCoopers, but I was in Silicon Valley, so that does influence you. And was actually part of the boom and the bust, around the turn of the century. So obviously for some of our younger viewers who are just getting born around then, the millennials, so kind of saw that from the outside and the first brush with venture and startups was to the Mumbai Angels, the group where I met my co-founder Karthik Reddy. And Karthik's background also similar in the sense, engineer, MBA, and spent time in the US and went back. The US, just like India, being a vast country, we didn't know each other, even though our paths had crossed. And at some point around the turn of the century, we were both in San Francisco, and we may have seen each other in the streets, like you sometimes think. Um, and that was the start. The idea was very much a what is called a super angel fund, or a micro VC, like a seed index fund, and that's how we started. But for me, the start was really Naveen Tiwari at InMobi and his co-founders. One of the first investments with the Mumbai Angels, where I was very intrigued, where the first wave of, I would say, the first wave of entrepreneurship had started. Junior of mine, Funny Sama of Red Bus had started Red Bus, and then Avnish and Suvir had started Bazi, and I was very intrigued because I have a US lens of how some of these founders, especially the Bazi founders, had come back from the US, from the Silicon Valley, from the land of innovation, and were seeking to build something in India, not here. And I was very intrigued, and it's just so worked out. And that was the genesis why I decided to move back. Karthik had already moved back from the US, and we started. So it wasn't the traditional path where you've been a VC in the Valley and you come back to try and replicate the same in India, but it was actually the Mumbai Angels, far away from Silicon Valley. That was the birthplace of Blume.
Right. Yeah, that's a very interesting story. And since you've just recently announced the close of Fund 4, which is a $250 million fund, what will be the focus of this new fund?
Yeah, we've stayed quite true to our stuck to our playbook, which is really essentially being that first institutional check. And so I'll just break it up. Sectorally, we would do about 60% what we call built in India for India, which is really the India story, back in the India story, true transformative sectors. So, broadly consumer internet, but fintech, agri-tech, edtech. You see the team also writing a lot about this. Sajid Pai, writes a lot. He's our, resident sort of thought leader, writer, and VC, come VC. And of course, fintech is very transformative. And then the 40% is what we call, built in Bangalore, Gurgaon, Pune, Chennai, for the world, which is really, deep tech, IP led, SaaS, enterprise SaaS led global markets. So sectorally, it's that. Our core has moved up, the core check, if you will, the core check that you cut, because if you look at it, we've become so much more of a robust and mature economy and industry. You have 2X founders, seasoned founders coming out from Freshworks on the SaaS side, from Flipkart on the consumer side, from so many of the IPOs that have happened. And so the second time founders are raising larger rounds. And also, since the quote unquote winter is here, some of them also want to raise or raise once and get back to building, versus just keeping on the road all the time, because it's immensely time consuming to be on the road. Ironically, we would love, the VC community all needs to move much faster and cut back companies, but we take our time, and it's very time consuming for the founders. So I think we want to be cognizant of that. So sectorally, pretty much the same, this 40-60 split. And check wise, the check size has moved up to about 2 million. But we also actively support companies in the earlier stages. We have a formal program which we manage. We call it the early stage network program. And we will also back companies just to help them and get them started, and then look at them in later rounds.
Right, absolutely. And since Bloom is like such a big name in the VC industry, now not just in India but globally right now, and what do you think have you done differently than the other VC firms? Because now I believe Bloom is about a decade old, a VC firm, and so what do you think you did differently in the initial stages of the firm that has made you come to where you have come to right now?
Yeah, a word we see being used a lot is, what is a founder superpower? What's a VC superpower? What's the secret sauce? I think for us, a lot of people also throw around this word of being founder friendly. We looked at it like with the first principles lens and said, how do we design this around the founder? How do we help founders? And I think one part that's differentiated about us is our platform. So it's interesting, right? It's quite a tricky sort of a math problem, because the smaller that you are, the earlier stage a founder is, and the smaller the fund is, the more help the founder needs. But the lesser fees that you have, right? You have less to spend on things beyond investments. But we spent very early on, Karthik and I made a couple of recce trips. We met folks like First Round Capital, we met tech stars in the US, we met Andreessen Horowitz, and we just were very intrigued by the idea of a platform. Everybody talks about smart capital. So we said, if we can design a platform and actually have a lot of non-capital functions also to help the founder, that's really what they need, right? If you think about it, if you dive into it, board meetings are not really, I mean, of course they're value added, but it's more of updates and discussion. But the real secret sauce happens in that time, between board meetings, right? How are you rolling up your sleeves and helping them? And when I was at IBM, I was at PricewaterhouseCoopers, PwC for about 4 years. IBM acquired it, so I spent about 8 years across it. They kind of invented the concept of on demand, and one of the lines was they would go to enterprises and say, "We'll fix your mess for less." We'll do your mess for less. And if you think about it, like a startup managing it can be messy, and you want the founders to the way I think about it, I want my founders to focus on just three things, right? On talent, on hiring, on building product and selling. That's it, right? Nothing else. Now, what about all the other stuff? Whether it's taxes, it's compliance, and it's managing your finances, it's reporting, everything. Who's going to help you with that? You don't want to be distracted. So we set up a platform team. I think that is something that is special, different, and it's not easy to do. It's not about throwing money at a problem. You really have to design it from the grounds up and bring in people who are domain experts who really care about that. Right? So I think that's one thing that's different. Also, I would say that we are also very realistic and we are not prescriptive. And what I mean by that is, uh, a lot of people will look up to us, and because you have things certain, but we always remember that we are not running those companies. We're not running the startups. So I think we are very realistic that we are not running the companies, and we're not prescriptive in the sense we listen. We're sounding boards. But I think what's different is we're also not telling the founders that this is how you should run it, and change your business model, because you're backing them, right? If you were running a company, then you'd be doing a startup and not running a VC fund. So I think the platform and a less prescriptive and more of a like supportive orientation is, I think, special about Bloom.
Right. Yeah, that sounds like very all around and very complete value add process there, where you're not just providing the capital but also doing handling the grunt work for the founders as well. That's not the core part of the business, right? That's great. And one more thing I wanted to ask is like whenever a big fund gets raised, this one question keeps getting asked, that the bigger you raise, the bigger you go in your AUM, assets under management, it's harder to return that fund. And I know for a fact that Bloom has been able to return even some of the big funds, like previous funds, which were also significantly big. So how would you like to answer that question? Like, will Bloom be able to return this fund as well, which is like $250 million?
It's a great question. One of the challenges of venture capital has been that, as like you said, the fund size has become larger, will the size of outcomes support it? Because your size of outcomes have to be proportionally, commensurately as large, right? For us, 100 million going to 250 million now. And if you think about, let's say, if you're shooting for a 5x, it's a 5x, but the same multiple, but in terms of dollar values, many times higher. So a couple of thoughts. I think one is, the good part is that the Indian ecosystem has matured tremendously. If you think about it, when Karthik and I started Bloom, and Ashish, our third partner, joined us very soon after. One of the questions we used to get on our roadshows is that, why should I care about India? Where are those size of outcomes? You had Paytm sitting for the longest time. You had Make My Trip, but you could literally name them on one hand. And if you look at it, just using the term unicorn, even though it's a bit of a vanity metric, and it doesn't mean everything that that people think it is. We've crossed 100, right? So the volume has increased, and also the scale. Just to give an example, right? Redbus's acquisition, back in the day, 2008, 2009. I don't know. I don't remember the exact year. was 140 million, which is a huge number by that in that era. Bazi was acquired by eBay for about 50 million, which was huge, right? Something to look at. Today you have Series C's, which are as high as that. So I think the fact is that the size has increased. That's one. Um, I think the way we'll do it is, I think ownership and I mean, you hear us talking about a lot about that we are conviction capital, which is we've become far more thesis driven. And the reason that's important is we actually, it's not an opportunistic bet. We have a thesis, we map the thesis to the founder. We're going with high ownership, and that is important. When you're returning the fund, we also have this first principles belief of both nurture and both nature and nurture are required. And so I'll explain. What I mean is, nature is picking, right? So you obviously have, I mean, the founder has to have a great DNA to pick. You can't turn lemons into let's say lollipops, but you have to nurture them. And I think the nurturing comes from the mentor ecosystem, the platform to help them, to drive them to outcomes. I think the third thing I would say is to become very, very outcome driven. To return a large fund, you have to become outcome driven. You have to look at globally. You have to look at all kinds of options, whether they're secondaries, continuity funds, strategics, local IPOs, international IPOs, partnering with corporate VCs. So all of that. But I think becoming outcome driven, and then just making sure that platform is there to help those companies, and not like, okay, we back them, we sit there. And that devil's in the details, right? That is a really tough part of venture. Is So I'll give you an interesting line. I was talking to a founder of a private equity firm, and said that essentially our business is about four levels in this value chain, which is really finding, grinding, minding, and harvesting. And if you think about the first, everybody wants to find, right? It's the most exciting thing to talk about. If you look at media also writing about it, is right. Oh, ex Flipkart founders and Freshworks founders get a 5 crore angel round, and then all the angels are named, which is fine. But we need to really focus on the stories and the outcomes, right? Not just these things. So and then the grinding part is interesting, but the minding, which is the most important, nobody wants to do, right? Everybody wants to move to that next new deal. So I think the nurture part is the real secret sauce, and I think that's the toughest part that will lead to outcomes and differentiate these larger AUM funds from the others.
Right. And you mentioned about your thesis and the finding aspect. So when this, I believe like there must be a ton of deal flow coming to Bloom since it's one of the biggest firms in India. So how do you filter out those pitches that you get, and then how do you evaluate those investment opportunities, or if whether those are good investments to make or not?
No, I think great question. Because the volume is so high in India, I would say that it's almost like, how do you filter out what you don't want to do first? And if you think of the power law, like Peter Thiel talks about, how do you quickly filter out what you don't want to, and then spend disproportionate time of what you want to? Because I think the challenge in our business is, it is not a leveler. It is not about equal businesses. And the challenge and the danger we always feel is, you have 100 deals. Let's spend 5 minutes filtering each, and that's not at all what we should be doing. So the mechanism is, we have a large team. We've got, I would say, one of our most incredible parts is actually the team itself. And we have a young team. The average age keeps on getting younger every year. And we've one way we've done it is by being sectorally specialized. So we're not we don't we believe that the era of generalization is over, and the era of specialization is begin. I mean, starting from my own perspective, I've not, I won't say I've moved, but I've moved back to California, moved back to the US, because I'm sectorally focused mainly on enterprise SaaS, cross border. And so my sub team, or, my colleagues are sort of built around that. Similarly, like a Sajid Pai would look at marketplaces, edtech, consumer, and, his sub team is built around that. And that's the way to do it, because, you're becoming sectoral experts, but you're still pulling in the best of the platform for Bloom for the others. And we have, every week we're filtering to, and so every lead or every sector is looking at their companies probably, and then they'll invite others to join the calls, very much like the Zoom. You'll have about four founders pitch, about 5 or 6 teams pitch every week for half an hour, and then the requisite team members are allowed to join. And I think Zoom is very interesting because it allows you to filter. I mean, think about human nature. It's not even good form. You can't go to a coffee shop, and if you don't like it, you can't wrap up in 10 minutes, right? You can't tell the waiter, don't bring the coffee, for both sides. I actually, this is a really important point I'd like to mention. I think it's really important for founders to equally diligence the VC, because I feel it's even more important. Remember, we are spreading our bets, we're doing many deals. The founder is putting their life, his or her life, in the hands of the VC. A lot of people feel it's one way street. I feel the other way street is equally, sometimes even more important. Is that VC right for you? Are they even looking at your sector? Are they, are they, sorry to say, but are they killing time because they have to fill out a logbook that these are the startups you met this week? So I think the filtering is really key. Every VC has its own. The way we are doing it is by being specialized, and by trying to filter out very quickly what we won't look at, and then spending more time on what we will.
I totally agree. I was recently talking to a founder, and he was saying that I'm going to build an MVP and then go pitch VCs. And I said, like, before you go do that, like, let's have a conversation, because there are a ton of mistakes that founders make right at the initial stage when they're going out to raise. Because at that stage, like, many other founders are kind of desperate that whatever money we get, it's good money, right? But that's actually not the case. It's the most sensitive stage, and you need to pick your VC right at that stage, and that will determine by a great extent whether your company will succeed or not, right?
And, that's a great point. Not only who you pick, but also what structure you do. You actually sometimes see that that's the time the startup is most vulnerable, the most open, because they have to get started. That getting from 0 to 1 is the most difficult part. And Peter Thiel is, the title is book on that. The tough part is not only do you have to pick the right partner, you have to pick the right partner with the right structure, because it's like like a relay race. If your shoelaces aren't tied, or if your if your legs are tied together, even if you start at 100 meters, you're not going to win, right? So the structure and the partner has to be set up right from the get go. Very difficult to undo later.
Yeah, I totally agree. And now, talking about the founder aspect, like, since you're investing in the early stages, and the decision is a lot based on who is the founder, and is the founding team the right team to build this and take this to where they want to take this to. So what do you think are the common traits of founders that keep winning?
I'll begin with just a quote I heard from somebody, just in Hindi, and it goes like this: that somebody said, "Ki sabka suno and khud ka karo," right? And I'll tell you what I mean by that. I think founders, the good founders that have succeeded, or tend to succeed, are the ones who are just constantly listening and adapting, and adapt at they know that they have to improve. They're looking at self-awareness. They're listening to the market, customers, investors. But essentially, at the end, they're doing what they do. They're doing and they have to, because think about it, if you listen to everybody, you'll do nothing. You'll be a disaster. So I think one aspect which is very critical is that constantly listening and learning from the market, from customers, from investors, from the peers. That I think ability to listen and to be open to feedback is critical. Early on, I'll give you an example. If you're a SaaS founder and your customer's telling you, almost helping you design your product, they're like partnering with you. You make them a partner and ally, and you design your product. You have to be open, right? You don't say, "Oh no, but I started with this," being let's say, an AI platform, and it's a technology, but but I'm not listening to your feedback. Just some kind of example, right? So I think constantly listening to feedback is very important. I would say the what we like to do is we also make intros. We like to be helpful. When we meet founders, we like to make intros to potential customers, to sometimes a couple of micro VCs, sometimes just to domain experts, and we do feedback loops, and we see how what they thought about it. I think the ability to obviously very passionately convince and persuade, of course, is important, because I think Mike Maples at Floodgate had an interesting podcast and said something very interesting, which is stuck by me, which is um, an entrepreneur is he or she basically paints a picture of the future transports you in a time capsule, 10 years ahead to believe in that future, and then brings you back, and then you have to fund it. Like, it's almost making the impossible possible. uh, how do you do that if you can't convince people? I think the most important people to convince are your co-founders. Co-founders are more difficult to convince than investors and investors, because the co-founders with you throughout the day, throughout for 10 years. Investor may exit after 4 5 years. Angels may go, you may also get secondaries. So I think that ability to convince and persuade with a real mission and passion, not just being a salesperson, but mission and passion, is very important. I think the last one, which is very difficult to assess early, but is, are they afraid? How comfortable they are? Uh, like when we're starting, you said, Sanjay, be comfortable, right? So I will use that word. How comfortable are they by hiring great people, sometimes who are better than themselves, and also letting people go who are not performing, right? Now, it's very difficult to assess when you see somebody on a Zoom, or see them in a Costa Coffee in Bangalore, or your SDA in Horsecast. How do you kind of assess them, right? They're small cues, actually. It's difficult. I think the social cues are very important. Um, you see how they deal with, I'll use the word ordinary people, right? Uh, do they, for me, it's very important. Does somebody talk differently to me, but they're ordering coffee? Will they talk very differently to the waiter? How do they, very often it's very interesting. You do one meeting on a Zoom, the other meeting to a restaurant. Just see, and just, as an example, just allow them to order, right? Just see how they will interact with everybody around you. That gives you a cue of how they will deal with people, which is separate from your domain. You have to be brilliant, product wise. So I think that aspect of how they're able to surround themselves with good people, because that same orientation will go to her building your board. Let's say a customer advocacy group, advisory council, your first hires. Will these people want to come and work for you? Will they respect you? And that aspect. So that, I think, that comes with experience. Sometimes, like, you're trying to judge a person. Those traits are very important.
Right, absolutely. And you mentioned about the co-founder aspect, that you need to convince your co-founder, like on the mission and on everyday decisions that you're making on an everyday basis, right? So there's one big question that aspiring founders face: that is a co-founder necessary? Right, they have an idea and they want to build it. Is it necessary to find a co-founder? Because there's this narrative that VCs won't fund you until you find a co-founder, right? Do you believe in that?
So, it's a really interesting question. I would say, if you look at most startups, almost all startups, storied startups, successful startups, at the end, they're usually associated with one person, right? I mean, um, right from, let's say, Ola, it's almost like you have like a rapid fire. You ask about Ola, you hear about Bhavish. You ask about, of course, I think Flipkart, both the Bansals were there, but you could, still have the same last name. Uh, but think about it. So usually it's around, or Facebook, Meta is Mark, right? Elon, the list goes on. That said, I think, two things. I think the reason to have a co-founder is not to have a co-founder, but to not drink your own Kool-Aid, right? Think about it. So, for example, let's say you start your company and you're out. My pinned tweet on Twitter is exactly about this. It's an extremely lonely journey at the top. um, most people who don't believe you will not tell you the truth, or sometimes there are people who don't want you to succeed. There are people who want you to succeed. Who's truly in this with you, right? Like, the Forbes article has this. At the end, they always have a topic on something. So once it was about siblings, right? And they said your siblings, if you have a sibling, the sibling is the only person in the world who knows what it was like to grow up like you. Nobody else knows, right? uh, when you have a co-founder, is the only person along with you who knows what that journey is. So when you're a single co-founder, I would say, some people say, "Oh, I'll keep the equity for myself." That's one way of looking at it, right? I've got 80% equity. You share karo, right? I'll share with the others. The other is that it's very lonely. Who's there with you to share it with? Who's there with you in this journey? You're putting tons of weight on your own shoulders. Who do you have to share it with? Now, sometimes you have 4 5 co-founders, which I think is, that's sometimes it may be too many cooks spoil the broth. I think 2 or 3 is always right, but I think they have to be very very complementary roles. So if you look at, let's say, look at InMobi, look at some of the others. Typically, one person is product oriented, one person is very sales oriented, and one is, let's say, uh, the face or the people person. But two is good, three is also good. I think it's a lonely journey if it's a single co-founder. That's not to say that there won't be one main co-founder. Of course, there will be, always, like I said, right? But I think it's a very lonely journey, and it's a tough one to do by yourself.
Right, absolutely. And since you are, I believe, investing across the Indian and the US startup ecosystem, right? So I want you to contrast how are these two markets different at this current stage?
Absolutely. See, I mean, it's good to look back in history also. The US venture capital industry is extremely old, right? We're talking about 50, 60 years old. I mean, Sequoia has a tree. You have lots of those valley VCs that are, around trees, where there's redwood and, all those kinds of things, which are trees that, like sort of perennial evergreen trees. And of course, we are also, Bloom, helping startups and, Bloom Forever. Um, that I think that gap has narrowed. If you think about it, our industry, I would say, started in like about 20 years ago, in the mid early 2000s, right? A couple of aspects. I think we didn't have the concept of, so they are different. I'll highlight the differences and how the differences have narrowed and changed. We didn't really have the concept of 2x entrepreneurs, seasoned entrepreneurs. Most of the entrepreneurs who came in were from the services background. They were like legends, made from service industry, the founders of Infosys and Wipro and stellar sort of bellwether companies like that. If you look at, I think that is a huge difference. The maturity of 2x serial entrepreneurs, founders and operators now in the ecosystem, that has changed. And that is becoming. I don't think we have to be similar to the US at all. I think we are very proud to have our own ecosystem, and and I'll talk about that. I think another thing that has changed is the sort of depth and scale of M&A and also corporate activity. In the Valley, corporate VCs and corporates are very entwined, and they speak the same language, and they very often are ex VCs. There's a lot of commingling, pollination between corporates and VCs. In India, traditionally, it was traditional, right? You had a corporate, just like let's say a Mahindra and a Reliance, and then you had startups, and it would be almost like 10 years ago, like a favor. Okay, let's meet the startup. Dekhte hain ki kya bana rahe, right? And today, if you look at it, just see how active Geo is. I mean, Geo, you could say, is arguably the world's biggest startup, right? Corporate startup. Tremendous change there, right? If you look at all the corporate ventures, whether it's Mahindra, Reliance, Tata's, everybody. So I think that's been a huge sea change. Um, I think what is different is our youth and our massive consumer market, right? I think we have I would say, the smartest young population in the world. I would say our talent to cost ratio is the highest. Our average age, I think Bloom's a great example. Average age keeps on getting younger and younger. Local languages, I think differences, whether it's dialects, our differences become the opportunities. I mean, start from vernacular content. We have a company called Stage, which is in Haryana, has paying customers, is just doing Haryanvi content. I mean, I think that's staggering and that's amazing, right? People would say, wow. If you look at my India WhatsApp, we've got couple Paji, right, on my on my WhatsApp. If you see it, I mean, he would be honored, right? He would be so excited. Wow, there's a vernacular content community platform that is just focused. So those local opportunities are tremendous, and just scale and replicate that across India. And I would say that I think on the SaaS side, the ACVs, average customer value, and the sales cycles are typically long and sometimes frustrating for startups. But that's also changing, right? You have like Israeli startups today selling deep tech, solutions to India, and we've become far more responsive. So that gap has narrowed. I think IPOs, of course, there's been a huge gap in tech IPOs between what happens in Nasdaq in India, but that's also changing. So I would say they're different. They should be different. We're very proud that our ecosystem is different in India. But I think that scale and the next decade should be very exciting.
Right, absolutely. And it is being said, I've heard it many times now, that this is going to be India's ticket. Like this is India's time right now. So and since your new fund is especially India focused, so what is your opinion? Like, what makes India the next big opportunity or the next big place to invest?
Yeah. So, I talked about it earlier in the discussion. If you look at the scale, I mean, I've lost count, but we have more than 100 unicorns today. I would honestly tell you, I remember there was the India Internet Day that happens in Delhi. I remember Hans Tung of GGV being on the podium and a keynote, and he's interestingly, I mean, because they invest in China and the Valley, he's actually a big Indophile, and I remember he threw the gauntlet and said that there will be 100 unicorns, and there are. So I think again, I think our youth is super interesting because it's the consumer segment. Secondly, youth is also the ones who are going to create startups of the future, right? So I think that demographic is so interesting. They're incredibly tech savvy. You're basically growing up. I'll tell you what is really interesting. When I come back to India, and I come often, and I see a Yulu bike, which is one of our portfolio companies. Hamid, started Glance. He was ex in Mobi, and that's very close to my heart. And then you see a Dunzo driver sitting on a Yulu bike, right? Maybe using like Google Pay code. Of course, Google is a global company, but when I see that Dunzo driver on Yulu, not only is it very dear to Bloom, but it's dear to India, right? And then you see the person riding the bike is young. The founders of these companies are young, and you're basically backing India's youth, right? So I think that is very, very special. Um, Also, I think in the lockdown, what's happened is, I mean, I don't know what the right word to describe it is, not lockdown, but um, the remote, let's say the move to remote, is that for product led growth for SaaS especially is booming, because today it's shown that you can build fantastic software companies from anywhere. Canva got built from Australia. UiPath, got built from Romania, and I think Bangalore, Gurgaon, Pune are going to be not are going to be already the next stops, because you know. Even if I was in Gurgaon, my sense is we would be doing this on Zoom or on your or forum. So today it doesn't really matter, right? That the technology is really leveled that. So it's a huge, incredible opportunity for India to build. And I would say that the other opportunity is in Bharat, right, outside the metros. Whether it's agri-tech, whether it's impact, right? Today we have companies like Stellapps, looking at, of course, Jai Kisan, looking at like fintech, impact lending. I think impact investing, and I think interesting trend is impact and private equity meeting venture. They're meshing and happening earlier. They were all very different silos, right? Impact investing would be just rural. Private equity would look at, like, infrastructure, roads, and then venture capital would be just digital and tech. But now all these are coming together, and I think that is very exciting, and we just have the numbers to keep it exciting. The last thing I would say is we just have to we have to just get our physical infrastructure much better, so that people spend less time commuting and spend more time being productive.
Yeah. Yeah, great that you covered the Bharat aspect of the India opportunity. Like, since India is a big country and a big market, and there are diverse sets of people, and there are like different kinds of products that are going to be built. Like, they're going to be enterprise products as well, but then there is also a big market in the space that is not very well connected at this point, right? Now, we all know some of the names that you mentioned, that are your portfolio companies. There's Dunzo, there's Yulu, there's Unacademy. So those are some of the big names.
Yeah.
I want you to mention some of the lesser known portfolio companies that are doing some exciting work.
Yeah, it's a tough question. I'm just thinking about that. It's like you have a family of 100, and you're thinking about the ones that did it. No, you're absolutely right. In one sense, on the consumer side, the big brands are also the ones that have spent and are well known, of course, advertise on IPL and things like that. But we have some very interesting companies. I think here in the US we have a company called DataWeave, which is doing digital shelf analytics, and what that is really, here, if you have like a Dunzo or DoorDash, what they're doing is they're helping them find out what SKUs are selling, what they should stock. Of course, it's more enterprise, so it doesn't really touch the customer, but they're helping Walmart and everyone sell more. A very interesting company. We back from the first one called DataWeave. I think of course, LBB is interesting, but it's also known, right? Especially known in Delhi, and they just had an exit. Um, uh, Let me see who else we have a company called Tartan Sense, which is doing very interesting work in precision robotics. So they basically help farmers in India, and find out exactly there's equipment, there's infrastructure, find out exactly what crops should be sprayed, when they should be sprayed. Jessima is a Carnegie Mellon alum who came back and is applying robotics to an impacted area of agri-tech. And then we have some newer companies from Fund 3 and Fund 4. Of course, we like all our companies to be known, and I'm sure there are a whole bunch that we are forgetting. But it's the family is growing. The family is growing and is growing in very very different areas. So I'll think and I'll come back towards the end if I think of any more names.
Sure, sure. Great. And now, again, touching upon one interesting aspect. So, when you're investing, the end goal is always to get to an exit, right? Because that's when you get to that liquidation event, right? And in the current market, it's an interesting thing, right? Like there are many impending IPOs that are waiting to happen, not happening right now.
Yeah.
So what's your perspective on that? So I want two aspects of this. One is, while you're investing, how are you thinking about exits at that point of time? And another perspective on the impending IPOs.
The question is about exits and about like planning for exits.
Right.
I would say it's a great question. I think that has been one of the knocks also on sort of Asia and India ventures, that there's lots of scale, there's a lot of paper value, marked up value, but where are the exits? And I think that I mentioned earlier in the discussion that I think as an industry we all try to be a little more outcome driven, and how do you help these companies get now? If you look at the recent history, especially a company like Delivery, I think that is a great example where it's rewarded profitable companies that are, I'm using those buzzwords, were basically built on pretty sound fundamentals. And if you think of in our own portfolio, like a Purple, right, which has become a unicorn. Manish and Rahul have built a fantastic platform that's very focused on a large swath on cosmetics and going after the women segment. Or if you look at Shivko building Exotel, Shivko and Ishwar building Exotel, cloud telephony, these are, I would say, India plus pan India, pan Asia companies, solid fundamentals, profitable, not needing constantly. Of course, Purple is in a very different industry, but these are candidates, right, that could go public. Um, uh, Similarly, on the SaaS side, right, Locus and Logistics SaaS, or Lambda, which is doing global automated, a full stack testing platform. They will similarly, no, like nobody plans for an M&A, right? You plan to go public and stay independent, but along the way, if you get a very attractive M&A, do it. I think one change in behavior that we're seeing, positive changes, that this startup founders that start, along the way they actually become trained and they develop that muscle to kind of operate like public company CEOs. Even today people talk about Mark and the others. They do, even top founders, did they know what they were in for, right, when they took the company public? You have to operate it. You have to operate quarter to quarter. You've got to give Wall Street numbers and then beat those numbers consistently. So that discipline that comes in is helpful. You have fiduciary responsibility, right, to deliver numbers. And I think that's changing, that's happening. The sort of winter has sharpened the attention on that in a good way, that there's certain responsibility, right, to do that. So I think Delivery and others that are coming up are positive. Who is not touched by tech today, right? Every single person, you mentioned you're in Delhi, whether you're involved in this industry or not, knows the brands, is ordering something on Dunzo. I know someone. I mean, today Yulu bikes are powering, the likes of Zomato not to deliver. They're using Euler Motors, another one of our companies, to do that. Everybody's touched by tech in some way, or has a nephew or niece who's working for a tech startup or a VC. So I think the IPO orientation is more important for founders to get, that this is a long-term journey you start, but essentially you should be in this to build a sustainable, long-lasting company, and not think of the IPO as just a flip to return money, but really to a new journey starts there. right? So I think the ones that have done it, like a Make My Trip, Deep, who's poster child and role model from very own Delhi, there, fantastic examples of people who are building very long term, long lasting, sustainable companies.
Right. Yeah, great perspective on that. And now, my last main question before we move on to our rapid fire round. So, this one is about what's something that you know now or you have learned now that you wish you had learned at the starting of this venture journey that would have probably saved you some mistakes that you made along the way?
Yeah, this is great. This could be a separate 1 hour interview. I'm looking at the sort of white hair in my hair, and that's where all this has come from all the mistakes that we've made. Um, I think one of the things that we did in Fund One was this is a very exciting business and excitable business. So you have a thesis in the space, and I think in some cases you got excited by the first founders that came your way, right? So we had backed somebody in the real estate space, and very storied founder, came from abroad, ex consulting background. This was in the housing broad space, and of course housing failed for other reasons, but it's a very big space, to transform real estate and classifieds. And we backed this founder because we like the space, but we just met the first founder. So I would say one lesson was that don't back the first founder you see. If you like a space, meet others, contrast them. And I think that's one learning, right? We just sort of rushed in one sense. When you're young, you rush in also. So I think that's one. I think the other is to also have this develop this what is called a prepared mind, and I'll tell you what I mean by that. We meet so many startups who are all going after very, very interesting but very diverse problems. So the prepared mind is really, can you have a certain thesis? You have a thesis, and you just park it there at the back of your mind, and you think about, for example, how should we be thinking about, like lending to farmers, or how should we be thinking about space tech? Just to give you two very different examples. Then when you come with the startups in that, it's like a prepared mind, which we didn't have in Fund One. And the prepared mind is really, you can kind of put them somewhere in that thesis, right? You map them. They're great founders, but if you don't have a thesis, then you're backing it a little opportunistically. You don't have a playbook. So I think that was the other learning, that to match that prepared mind, which is a thesis, with founders, right? That's important. And I think another part is also you don't overfund the company, you right size the company at that stage. You saw that in some cases like housing.com or the others, where you give them too much money, whether they're young or not. I mean, think about, you get money, you're going to spend it, right? Whether it is on a Friday night, a teenager, or whoever it is, you're going to do it. So how do you space that out? And how do you sequence that? I think that's important. I mean, I think the list goes on. I think the most important one is to diligence both sides, right? That is the most difficult thing. That how do you, in a very compressed time, how do you say that this is going to be a 10-year partnership? So I think testing them or meeting them in different situations, not doing one massive IC and for 3 hours and saying we're going to back it or not back it, but tracking companies over time, testing them, making intros, doing feedback loops. This is a very people intensive and time intensive process. I just say that if you don't like working with people, nobody should be in startup. It's a people business, not a it's a people flow business, not a deal flow business. Everything in startups is to do with people, right? The later stage you go, you start investing in balance sheets. So I think building that ecosystem to have your own team members interacting with startups. We started with a very small team. You can't do it. When we backed Anirudh and Pratik at Carbon Clean Solutions, or back Grey Orange, it was a very, very small team. Today, we can have sectoral experts, analysts analyze the space. Somebody meets the founders, then you do a Zoom. But those are all interesting learnings. But I'll tell you, there are no shortcuts, right? There's no the if you don't have learnings, and if you don't make mistakes, then you've just not done anything great. So the mistakes are the most interesting parts. Even the best investors, the Midas list investors, will first tell you about all the mistakes they've made.
Right, absolutely. Thank you for sharing those because I believe it's going to help some maybe new investors to save some mistakes. And even that first mistake that you shared, that we just bagged the first founder we saw in that space because we were excited in the space. I think this kind of applies to the founder as well. Don't just get funding from the first VC you find. Like do your own diligence as well, which is again a point you mentioned in the episode, right?
No, I mean, to use a different word, you also do your dating, just like the founders, just like the investors are dating
Exactly.
multiple things. You also have to do it. Don't pick the first VC you
Exactly.
meet at all, because how do you compare and contrast unless you meet four or five? You can't say this is the
Exactly.
best VC unless you met four or five. And I will say one point when you said about mistakes, I think it's also important. It's important to learn from the other mistakes, but it's very important to make your own mistakes. Because
Right.
just
Right.
imagine you have a young VC tomorrow on this panel, and you ask him the same question, him or her, and she can't talk about mistakes somebody else has made. She has to talk about her own mistakes. So I think it is important to make your own mistakes also.
Very true. So make your own mistakes if you want to have your own answer to this question when I have you on this podcast, right? Great. So now moving on to the rapid fire round, I'll ask you 5 quick questions about the fund, and you have to give 5 quick answers. Sounds good.
Sure.
All right. So the first one is, what are the sectors and regions you invest in?
All India focused. I mean, also cross border, as long as the India angle. And sector would be consumer, like 60%, and SaaS or built for global 40%.
Great. And what's the typical stage of investment?
Stage is pre-seed and seed, so 2 million and below. So anywhere from, like, let's say 250K to 2 million.
Great. And what's the typical check size? Oh, you mentioned that. So
Just covered it.
250K
Yeah.
to 2 million. Yeah. So, and where can founders pitch you?
Yeah, I know my Twitter is open on DM, but I think the pitch form, I think you highlighted, we have to tweak some of those, but the pitch form is the best, and we'll do that. I think info at Bloom at VC also they can send it to, but we will tweak that pitch form is the best.
Great. And the last one is, where can our listeners follow you?
Yeah, I would love to share, tweet, and write much more. I don't get a chance to do that. I think Twitter is probably the best, but I would love to take more time for doing things like this and share, because we're so busy running on a treadmill. But I think for now, Twitter.
Great. Great having you on, Sanjay, on the podcast. And I loved all the insights that you shared. I'm pretty excited for what you're going to fund next and all your portfolio companies. And let's build this India story together. Happy
Absolutely,
investing.
and absolutely, Prashant. I'll say it's a pleasure to be here. I'd say that all of you play such an important role because, uh, nobody also asks us otherwise about, our learnings and our mistakes, because we're always talking and we're always giving quote unquote gyan, to others. But I think it's very interesting to recount that, because we also learn about ourselves and about, what's needed. And congrats on your podcast and your own entrepreneurial experience. And it was a pleasure to be here. Thank you.
Thank you. Pleasure hosting you.